What if I told you a company just reported the best quarter in its entire history? Record revenue, record profits, adjusted earnings up 13%, and the stock actually went up. That is Moody's Corporation today. On April 22nd, MCO delivered $2,079 million in Q1 2026 revenue, with Moody's Investors Service setting an all-time record on over $2 trillion in rated bond issuance. And yet the stock is still trading 17% below its 52-week high. This is Charged Alpha, and today we are going deep on one of the most iconic names in global finance.
The paradox here is real, Hudson. Record results, stock climbed on earnings day, but still down significantly from the highs. The market is wrestling with a specific question. Is what happened in Q1 the new normal for Moody's, or was it a peak driven by conditions that may not repeat? Management basically told you both possibilities on the call: record issuance, record margins. And also, if tariff-driven volatility persists, we would expect mid-single-digit MIS revenue growth for the year. That is a very wide range of outcomes.
Exactly the tension we are going to unpack today. We have got the full picture: the business model, the financials, what the street is saying, the bull and bear case side by side. And I promise by the end of this, you will have a very clear framework for thinking about whether Moody's belongs in your portfolio.
And we will call out the key metric to watch, the number that will tell you quarter by quarter whether the bull case is holding or the bears are getting it right. Let's get into it.
Let me set the stage here. Moody's Corporation is a name most people have heard. It is the company that rates your government's bonds, your city's municipal debt, the corporate bonds that pension funds hold. But the business is more layered than just slapping letter grades on debt. Moody's has two major segments. The first is Moody's Investors Service, what everyone calls MIS, which is the ratings engine. The second is Moody's Analytics, or MA, which is a data, research, and risk management software business. Together, they generated $8 billion in revenue over the trailing 12 months.
The split matters a lot for understanding the investment thesis. MIS is the legacy business. It generates revenue when companies and governments issue bonds and pay Moody's to rate them. That revenue is inherently cyclical. When bond markets are hot, like they were in Q1 2026 with $2 trillion in rated issuance, MIS prints money. When markets freeze, think March 2020 or a tariff-driven panic, issuance drops and MIS revenue can fall quickly. MIS was about 56% of total revenue in Q1.
And then there is Moody's Analytics, which is a completely different model. MA sells annual subscriptions to financial institutions, corporations, and governments, data feeds, credit research, risk software, regulatory compliance tools. It is recurring revenue. Clients sign multi-year contracts for things like credit risk models, know your customer data, and portfolio analytics. That subscription base has been growing at 8% annually in terms of ARR, annual recurring revenue, and the margins are expanding. MA is what makes Moody's less cyclical than it used to be.
The way to think about it, MIS is the high-margin, high-volatility engine that produces extraordinary profits in good bond markets. MA is the subscription flywheel that provides a recurring earnings floor regardless of what bond markets are doing. When you put both together, you get a business that has historically compounded earnings at double-digit rates while riding out cycles better than pure ratings plays.
In terms of the customer base, MIS primarily serves the issuers themselves, meaning the companies and governments that are selling bonds and paying Moody's to rate them. MA serves the buyers of capital, financial institutions, asset managers, banks, insurance companies that need Moody's data to make decisions about credit risk. Those are structurally different customer relationships with different payment dynamics.
The competitive moat here is one of the most defensible in American finance. The NRSRO designation, Nationally Recognized Statistical Rating Organization, is a regulatory classification conferred by the SEC that essentially limits the credit rating game to three players: Moody's, S&P, and Fitch. You cannot just start a ratings agency and have institutional investors accept your ratings for regulatory capital purposes. That is a structural barrier to entry that no amount of venture capital can overcome.
And on the analytics side, it is a data network effect. The more institutions that use Moody's credit data over decades, the more comprehensive and historically validated that data becomes. A bank that has used Moody's credit models for 20 years has its own internal models calibrated against Moody's data. Switching means recalibrating everything. That is a switching cost that generates real pricing power.
The company traces its roots to 1900, when John Moody published his first systematic bond analysis. Over a century of credit history and institutional relationships is not something you replicate quickly. That institutional memory is baked into every rating and every data product Moody's sells today.
At the helm of Moody's since January 2021 is Robert Fauber, who serves as president and CEO. Fauber is not an outsider who came in with a turnaround mandate. He joined Moody's in 2005 after a career at Citigroup and spent years running the analytics business before being elevated to the top job. He has been the architect of the MA transformation strategy.
The Street views Fauber as a disciplined operator who has executed on the analytics pivot without abandoning MIS discipline. Under his watch, MA's recurring revenue has grown meaningfully, the company expanded into climate risk data and ESG analytics, and margins have expanded even as the business mix has shifted. The test management flag this quarter was a candid one. They told you exactly what conditions would cause them to miss the high end of guidance. That kind of transparency is generally viewed as a credibility positive.
His strategic bet that the ratings agency needs to become a data and analytics platform that is less dependent on issuance cycles is the core long-term thesis for bulls. Whether that transformation is happening fast enough to offset the next cycle downturn is the core question for bears.
With 5 years in the role, Fauber has navigated the post-COVID issuance boom, the rising rate environment, and now the tariff uncertainty period. His track record through those different market conditions gives you a relatively complete picture of his capabilities. All right, let's dig into the financials on Moody's. Starting with valuation, the stock is trading at approximately $455 per share, with a market cap of about $78.8 billion. On a trailing 12-month basis, the price-to-earnings ratio is around 30.8 times. Forward earnings, looking at the midpoint of management's guided adjusted EPS range of $16.40 to $17, implies a forward multiple of about 25 times. That is not cheap.
For a business with Moody's characteristics, near monopoly ratings franchise, expanding analytics subscription revenue, 62% return on equity, the premium is not shocking. But 31 times trailing earnings does require the growth story to hold. What does the revenue trend look like?
Revenue has been growing consistently. In Q1 2026, Moody's generated $2.079 billion, up 8% year over year. Both segments grew at exactly the same rate. MIS up 8% to $1.153 billion, MA up 8% to $926 million. Over the trailing 12 months, revenue is approximately $8 billion. That is a business that has expanded meaningfully since 2020.
And the margins tell the story of why people pay a premium for this stock. Gross margin is approximately 73%. This is a high-margin information services business, not a manufacturer with heavy COGS. Operating margin in Q1 was 44.3% on a GAAP basis, and the adjusted operating margin was 53.2%, 150 basis points better than Q1 2025.
MIS in particular is an extraordinary margin business. The adjusted MIS operating margin in Q1 was 67%. When bond issuance is running hot, every incremental rating fee essentially falls to the bottom line at 2/3 margin. That is the economics of information monopolies. Net margin on a GAAP basis was 31%. Return on equity of 62% tells you this business generates extraordinary returns on the capital it deploys.
Let us talk about cash flow, because this is where Moody's really shines as a business. Operating cash flow on a trailing 12-month basis is approximately $3.4 billion. Free cash flow is approximately $2.9 billion. For context, Q1 2026 alone produced $939 million in operating cash flow, up 24% year over year, and $844 million in free cash flow, up 26%.
That cash generation is what funds the massive capital return program. In Q1 alone, Moody's returned $1.7 billion to shareholders, $1.5 billion in share repurchases, and $185 million in dividends. The company has raised its full-year buyback authorization to $2.5 billion. At these repurchase levels, they are retiring roughly 3% of shares outstanding each quarter, which is mechanically accretive to earnings per share, even without any underlying profit growth.
Now, the balance sheet, Moody's carries meaningful leverage. Cash and equivalents are approximately $2.45 billion. Total debt is around $7.4 billion, giving a net debt position of approximately $5 billion. For a business generating $3 to $4 billion in operating cash flow annually, that leverage is manageable.
The debt profile is manageable, but worth noting. Long-term debt of roughly $6.9 billion is mostly fixed rate, which insulates Moody's from short-term rate moves. Short-term debt is approximately $500 million. Interest expense runs about $95 million per quarter, significant but dwarfed by operating cash flow. The leverage ratio is around 2 times EBITDA, which is conservative for an investment-grade issuer, which is somewhat ironic given what Moody's does for a living.
On dividends, Moody's pays a quarterly dividend with an annual yield of approximately 0.94% at current prices, representing an annual dividend of around $4.28 per share. With a payout ratio of about 28%, the dividend is well covered and has room to grow.
Overall, Moody's financial health is strong. The business generates exceptional cash flow, margins are expanding, return on equity is among the highest in financial services, and the leverage is fully supported by the earnings power. The primary concern is not the balance sheet, but the cyclicality of the MIS segment. The financial engine is working. The question is what the fuel supply, meaning bond issuance volumes, looks like for the rest of 2026.
What does the street think about MCO right now? The analyst community covering the stock is strongly constructive. Out of 20 analysts, 17 have buy equivalent ratings, 3 have hold ratings, and 0 have sell ratings. The average 12-month price target is $546, implying about 20% upside from current levels. The high end is $660, and the low end is $460.
The bullish skew in ratings makes sense given the business quality. Barclays upgraded to overweight in March. JP Morgan and Goldman Sachs have maintained buy and overweight ratings heading into Q1 earnings. RBC Capital confirmed their outperform after the results. The 3 hold ratings likely reflect valuation discipline, acknowledging the business quality but noting that 31 times trailing earnings is a full price.
The price target spread is interesting. The $60 range between low and high essentially captures the bull and bear scenario math. If MIS revenue normalizes to mid-single-digit growth and the multiple compresses to 25 times, you get to 460. If Q1's record issuance pace holds and the multiple stays above 30, you get to 660. The stock is pricing in something in between.
On the latest earnings result, Q1 2026 revenue came in at $2.079 billion against an estimate of $2.082 billion, essentially a rounding error miss of $3 million. Adjusted EPS of $4.33 beat the $4.28 estimate by a nickel. GAAP EPS was $3.73. The record MIS performance and margin expansion were the headline items.
And critically, the stock moved higher on that report. That is a very different dynamic from what we have seen with some other earnings reports in this environment where beats are sold aggressively. The market gave Moody's credit for the record results, even while acknowledging the management caveat about tariff risk.
Which brings us to the real debate, bull case versus bear case. Both are coherent. Let me give you both so you can think it through for yourself.
On the bull side, let me lay out the bull case. First, bond issuance may be structurally elevated, not cyclically peaking. Companies across investment grade and high yield have been front-loading their financing needs, locking in debt at current rates before the tariff situation potentially drives either a rate spike or a credit tightening. If CFOs continue to use the debt markets opportunistically, $2 trillion per quarter in rated issuance is not a one-time anomaly, but but a new operating environment that benefits MIS.
The bear case on that point. MIS revenue is highly correlated with economic confidence. In any serious tariff-driven slowdown or if credit spreads widen materially, companies pull back from bond markets quickly. We saw this in early 2020 and in late 2022. MIS revenue can fall 20 to 30% in a bad quarter. Management explicitly told you that mid-single-digit growth is the downside scenario. That is not a catastrophe for the business, but at 31 times earnings, it may be a catastrophe for the stock.
Bull case number 2. Moody's Analytics is the strategic transformation that changes the cyclicality equation. 8% ARR growth and 250 basis points of margin expansion in a single quarter. As MA becomes a larger share of revenue, approaching and potentially exceeding MIS over the next 5 years, the multiple should expand toward the MSCI level, which trades at 17 times revenue because of its near-pure recurring subscription model. If MCO's multiple re-rates from 10 times revenue toward 12, the stock has 50% upside from here, independent of earnings growth.
Bear case on analytics. MA does not have a monopoly. Bloomberg and Refinitiv are formidable, deeply embedded rivals with complementary data and execution capabilities. And the AI threat to analytics is real. If generative AI tools can replicate credit research outputs that MA currently charges premium subscription prices for, the argument for MA's pricing power weakens. 8% ARR growth is solid, but it has to be set against a backdrop where AI is democratizing the very analysis Moodys monetizes.
Bull case 3. Capital return is doing real work. $1.5 billion in buybacks in a single quarter reduces the share count by roughly 2%. At a 25 times forward multiple, that buyback alone adds about 40 cents to next year's EPS. The $2.5 billion full-year authorization implies continued accretion. In a slower growth environment, buybacks are the difference between flat earnings and mid-single-digit EPS growth.
The bear pushback. Buying back stock at 30 times earnings is not a bargain. Every share retired at $455 is capital that could compound elsewhere. The buyback math works as an earnings support mechanism, but it is not a substitute for underlying business growth. If MIS revenue slows materially and the multiple contracts, the buyback program does not protect the stock. It slows the decline.
That is the debate. Two very coherent views, and both are grounded in real numbers. How does Moody's compare to its closest rivals in the financial data and analytics space?
Let's see how Moody stacks up against its peers. The most direct comparison is S&P Global, ticker SPGI, also a two-segment ratings plus analytics model. SPGI trades at a price-to-sales of about 10.9 times, slightly above MCO's 9.8. SPGI has the S&P Dow Jones Indices franchise alongside its ratings and market intelligence business, which some argue is more durable than ratings alone. Revenue growth is comparable at around 8 to 9%.
MSCI is the aspirational benchmark for Moody's in terms of multiple. MSCI trades at a price-to-sales of 17.4 times, nearly double Moody's. The reason is that MSCI is almost entirely recurring subscription revenue from index licensing and analytics, with virtually no cyclical ratings exposure. Every dollar of MCO revenue that shifts from MIS fees toward MA subscriptions narrows the gap between MCO and MSCI's multiple, at least conceptually.
FactSet Research is the third comparison, a financial data analytics platform that competes in MA's territory. FDS trades at a price-to-sales of about 7 times with revenue growth of 5%. FactSet is smaller and growing slower than Moody's, which is part of why Moody's commands the premium. The peer table tells you that in financial data and analytics, premium revenue growth earns premium multiples. Moody's sits between the SPGI peer and the MSCI aspiration.
Let's look at the options market for Moody's and what institutional investors are signaling. The put-to-call ratio on MCO sits at approximately 0.95, essentially neutral, with just a slight tilt toward puts. Implied volatility is at roughly the 45th percentile of the historical range, below average, which is consistent with a stock that climbed on earnings and is not in distress.
The below-average implied volatility here is notable. Compare that to a company like MedPace, which fell 20% on earnings and saw IV spike into the 65th percentile. MCO's options market is not pricing in outsized uncertainty. The market is treating this as a quality name with moderate macro risk attached, not an existential moment. That said, call clustering at the 480 and 500 strikes tells you bulls need a real catalyst, not just multiple expansion, but evidence of sustained issuance in Q2.
On insider activity, the signal here deserves honest reporting. Over the trailing 6 months, Moody's insiders have executed 16 transactions, all sells, 0 open market purchases. CEO Robert Fauber sold approximately 10,427 shares for roughly $5 million across 9 separate transactions, all executed under Rule 10b-5-1 prearranged trading plans.
The bull interpretation is standard executive portfolio management. Long-tenured executives at high-priced stocks accumulate concentrated equity positions through options and RSUs, and diversification via 10b-5-1 plans is the standard mechanism. These are not panic sells. They are pre-scheduled. The bear notes, not one open market purchase in 6 months, at a company management describes as having exceptional long-term prospects and a record first quarter. Executives who genuinely believe the stock is cheap relative to intrinsic value sometimes buy in the open market. None did here.
Let me bring it all together. Moody's Corporation is one of the most defensible businesses in American finance. The NRSRO designation gives MIS a structural protection most industries would envy. The analytics transformation is real and accelerating. The cash flow generation is exceptional. The capital return program is aggressive and accretive.
And the key metric to watch, the number that will tell you in real time whether the bull or bear case is winning, is MIS rated issuance volume. Q1 2026 set a record at over $2 trillion in rated issuance, driving MIS revenue to $1.153 billion. Management said directly, if that pace holds, they hit the high end of guidance. If tariff-driven volatility causes issuance to contract through Q2 and Q3, they trend to the low end. Watch MIS quarterly revenue. If it stays above $1 billion per quarter, the bull case holds. If it falls below $850 million, the cyclicality risk argument gains significant ground.
The setup is this. Record first quarter results, a stock trading 17% below its 52-week high, a management team that gave you both the upside and the risk scenario in plain language, and an analyst community that is overwhelmingly bullish. Whether the current price is cheap or fair depends almost entirely on what bond markets do over the next 6 months. That is the bet.
Both sides of this trade are rational. The premium is real, the moat is real, the cyclical risk is real, the analytics transformation is real. At Charged Alpha, our job is to make sure you see both sides clearly before you decide. And on MCO, both sides are worth taking seriously.
Before we close today, W. Edwards Deming, the father of modern quality management, said it perfectly. In God we trust. All others must bring data.
I cannot think of a more fitting quote for a company that quite literally sells the world's most trusted data on creditworthiness. Deming would have appreciated the irony of rating the raters.
That is going to do it for today's episode of Charged Alpha on Moody's Corporation, ticker MCO. If you found this breakdown valuable, please share it with someone who is thinking about financial data names. We do a new company every single week. And hey, if you want to run the same research workflow we use to build these episodes, everything is free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo. That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.